I'm Cynthia Rowland, and this is episode 46 of EO Radio Show. Many nonprofit organizations are required to have their financial statements audited by an independent certified public accountant. For example, a nonprofit charity that is required to be registered with the California Registry of Charitable Trusts and which has gross revenues of $2 million or more in a fiscal year must obtain an independent audit. They also must certify to the California Attorney General each year the amount of revenue received and that they have obtained an independent audit. Many other states have similar requirements. Today, I'm delighted to be joined by Certified Public Accountant Douglas Cook, who will talk about frequently asked questions that come up for charities that are facing their first audit and some unique situations that often surprise his clients.
Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun, and Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here.
My guest today is Douglas Cook. Douglas founded Cook & Company in 2011. As an experienced CPA with an MPA degree in nonprofit finance, Douglas knew he wanted to use his skills and knowledge to support nonprofits in their efforts to make the world a better place. Through this work, he began to realize there was an unmet need in the nonprofit sector for high-quality, reasonably priced audit, review, and tax services that catered to smaller organizations. And that's how Cook & Company was born. That commitment to giving back is still the guiding principle of everything his firm does. The entire firm strives to be as helpful as possible, explaining things in plain English, answering questions, advising staff on ways to enhance efficiency and effectiveness, and making sure the reports prepared are accurate and easy to understand. Thanks for joining me today, Douglas.
Happy to be here.
Before we dive into the details of audit stuff, tell us a little bit more about how you came to focus on accounting in general and accounting for nonprofits in particular.
Well, I started out in for-profit accounting, working for a rental car company. I learned a lot there about accounting and auditing and how numbers tell stories about an organization's financial performance and financial position, and how to connect the dots when looking at various parts of financial statements. But after a while, I decided that I wanted to use my skills for the greater good. So I went to work for a small CPA firm that specialized in nonprofits. I stayed there for a few years before starting my own practice, specializing in nonprofit audits. I feel that when auditors like myself and other accounting professionals work in the nonprofit space, I like to think that we are playing an important role in helping clients strengthen their fiscal infrastructure, which in turn better positions them to fulfill their mission.
Oh, definitely. The whole accounting process is often very, bookkeeping and accounting, very foreign to the charitable entrepreneur, the person who really wants to make a difference. And accounting is not their main focus, but it eventually becomes the ones that are well advised and that really have the support of a team like yours. It just strengthens the organization entirely. So thinking about that new or emerging nonprofit, the requirements for undergoing an audit are not always clear. How does a nonprofit determine if it's really required to have an audit in any particular year?
So if you're a finance director or an executive director at a nonprofit, probably the first thing I recommend doing is looking at your individual funding source requirements, both existing funding sources as well as potential funding sources that you may be considering. If any one funding source requires an audit as a prerequisite for funding, then you probably need to have an audit. Beyond that, if none of your funding sources are requiring an audit, the next thing to do would be to consider whether the state requires it. Now, each state has its own regulatory requirements for nonprofits, and they often include audit provisions. For example, the California Nonprofit Integrity Act requires an audit when a nonprofit's total revenue for the year is $2 million or more. However, there are exceptions. For example, if an organization receives governmental funding and they are required to furnish the governmental funding source with an accounting of how they spend the funds, then that funding may be backed out of the total revenue for the threshold. So for example, if a nonprofit has total revenue and support of $2.5 million in a given year, but $1 million is a government cost reimbursement grant, and the nonprofit is providing the funder with monthly expenditure reports in order to get paid, then that nonprofit may be able to exclude that revenue. So you'd back out the 1 million from the 2.5, which would bring the organization down to 1.5, meaning that they're not necessarily required to have an audit under the California Nonprofit Integrity Act, but they may be required to have an audit based on some other provision. And that's what I want to talk about next. So if a nonprofit organization solicits contributions from individuals or organizations that are located in other states, the organization may be subject to audit requirements in those states. And in some of those states, it only takes a few $100,000 in contributions to trigger an audit requirement. So if you utilize a service to process your annual state charity registrations, they can probably help you determine if you're required to have an audit. If you don't use a service, the Council of Nonprofits has a handy webpage that lists each state and its audit requirements.
Oh, that's great. We'll put a link to that resource in the show notes. It's really tough to get a handle on all the different state requirements. And so resources like that are super, super helpful. There are different types of services that an audit firm like yours might provide. There's a full-on audit, a compilation, a review. What's the difference between those three things? And, so maybe if our small nonprofit has determined that they don't actually need a full-blown audit, but they may benefit from a different level of service. Can you talk a little bit about those three different levels and what they mean?
Sure. So with each type of service, audits, reviews, and compilations, there are some basic ingredients in common. First, you have an organization's financial statements for a given period of time. You also have a CPA or a team of CPAs applying procedures to those financial statements. And then you have that same CPA issuing a report on those financial statements. Those are the similarities. Now let's talk about some of the differences. Audits and reviews are known as assurance engagements. An audit is the highest level of assurance that a CPA can provide with regard to an organization's financial statements. In an audit, an organization will hire a CPA firm to conduct the audit, and then the organization will provide its annual financial statements to the audit firm, and the audit begins. The auditors will perform extensive procedures to verify the accuracy, completeness, and reliability of those financial statements. The auditors will go through various procedures, such as evaluating the organization's internal controls. In order to design those procedures, they examine documents that support the amounts and disclosures in the financial statements, and they ask a lot of questions of the organization's personnel. Not only do they inquire of the accounting team, but they also talk with senior management and members of the governing board. They even communicate with third parties, such as the organization's banks and insurance carriers. All of these procedures culminate in an audit report where the auditors express an opinion on the financial statements. If all goes well, the organization will receive what's known as an unmodified or unqualified opinion, meaning that the auditor does not have any reservations, any material reservations with the financial statements. Essentially, the auditor is putting their stamp of approval on their financial statements. So then there's this other type of service called a financial statement review, which some people might describe as a baby audit. In a review, the auditors do some of the same procedures that they do in an audit, but to a lesser extent. So in an audit, the auditors dig pretty deeply to find material misstatements in the financial statements. But in a review, the accountants are scratching the surface to see if things pass the smell test. They do ask questions of personnel, and they perform analytical procedures to find potential misstatements in the financials, but they don't evaluate the organization's internal controls. That's a significant difference in comparison to an audit. And they don't look at nearly as much documentation as they do in an audit. As a result, the review engagement only provides limited assurance on the financial statements, whereas an audit provides a high level of assurance. So the CPA's report on the financial statements looks different in a review compared to an audit. In an audit, the auditor expresses a formal opinion on the financial statements, but in a review, the accountant does not provide an opinion. Instead, they include language that indicates that they are not aware of any material misstatements in the financial statements. But the implication there is that the financial statements may contain material misstatements, but they weren't detected because the accountants did not dig as deeply as they would have in an audit. And then there's this third category of service known as a compilation. In a compilation, a CPA takes financial information provided by an organization and compiles it in the form of financial statements that conform to generally accepted accounting principles, GAAP. However, the CPA is not required to verify the accuracy or the completeness of the information provided. They might ask some questions and look at some documents to help them put together the financials. And if something looks glaringly off, they will follow up with the organization. But unlike audits and reviews, compilations are not assurance engagements. A number of my audit clients do have monthly compilations performed, but the compilation typically does not replace the audit. So we do their annual audit, but they have a different CPA firm compile their financial statements each month. This can work out well because it means that the organization benefits from having GAAP-compliant financials all year. But if you are applying for a grant and the funder wants an audit, they probably won't accept a compilation as an alternative. However, they may accept a review as an alternative to an audit, especially if your organization is small and has not been around for a while. If your organization has never been audited and you currently are not required to undergo an audit, a review can be a less expensive alternative. It can also be a good way to get practice to go through a review for 1 or 2 years before embarking upon your first annual audit.
So that's a great idea to start out with the services that can get the staff and the entire team used to the third-party review, an independent person looking at the books and records and helping to point out any, I wouldn't say problems. It's usually more issues of keeping track of things. So I do want to talk about GAAP a little bit, but before we get to that, do audits come as kind of one size fits all, or are there different types of actual audits for different organizations? I'm thinking of like a healthcare organization wouldn't necessarily be the same as a school or a social service agency. Talk a little bit about the different kinds of audits.
That's a great question. Most nonprofits that are required to have an audit undergo what's known as a financial statement audit, which is essentially what I described a moment ago. However, for organizations who receive significant government funding, there are some additional audit requirements to consider. There is one type of audit known as a yellow book audit, and then there is another type of audit known as a single audit, and I'm going to go over each of those separately. So with a yellow book audit, you need to have a yellow book audit if you receive governmental funding. It can be state, local, or federal, and the funding source stipulates that you need to have a yellow book audit. A yellow book audit is also known as an audit in accordance with generally accepted governmental auditing standards. The acronym is GAGAS. In a yellow book audit, the auditor is not only reporting on the reliability of the financial statements, but the report also includes whether or not they encountered any significant problems with the organization's internal controls and whether or not they found any material non-compliance with government contract provisions. Now, a single audit, which used to be known as an A133 audit, is required when an organization expends at least $750,000 in federal funding in a given year. And I'd like to elaborate on a couple of key points here. The requirement is driven by expenditures. So what counts here is when federal funding is spent, not when it's awarded. The other thing to remember is that federal funding that gets passed through a state or local government or through another nonprofit organization is still considered federal funding and is subject to this requirement. In a single audit, the auditor issues an opinion on compliance and internal control as they relate to the federal funding. One last thing I'd like to mention with regard to these different types of audits is that they build on each other. What I mean by that is that the Yellow Book audit and single audit do not replace financial statement audits. Instead, think of them as adding additional layers that get added to a financial statement audit. Typically, if you're undergoing a Yellow Book audit, you're also undergoing a financial statement audit. And if you're undergoing a single audit, you're also having a Yellow Book audit and a financial statement audit. And they would all be performed at the same time by the same CPA firm.
All right, so picking up again. So talk a little bit about GAAP, the acronym for Generally Accepted Accounting Principles. What exactly does that mean? And does it change from time to time?
Essentially, generally accepted accounting principles are the rules that govern the accounting for nonprofit organizations and for-profit organizations alike. They are all required to follow these same rules to make sure that their financial statements accurately reflect the organization's assets, liabilities, net assets, revenues, and expenses. Interestingly, the GAAP requirements that apply to for-profits typically apply to nonprofits as well. But nonprofits also have a whole other layer of nonprofit-specific GAAP that they have to consider. This nonprofit GAAP is concerned with things like distinguishing between earned income and contributed support, restricted versus unrestricted contributions, endowments, functional expense allocations, and the list goes on and on. In many ways, GAAP can be more complicated for nonprofits than it is for for-profits. And yes, GAAP is constantly evolving, so you're always having to keep up on the latest pronouncements. GAAP is important because it helps to ensure consistency with the presentation of financial statements across organizations, and also when comparing different years for a single organization. It's critical that nonprofit organizations have people working for them who understand GAAP in order to produce reliable and consistent financial statements. This is important regardless of whether or not the organization is undergoing an audit.
When you say the pronouncements that change, who makes these pronouncements? It's not legislation, right? It's a national body that makes the decisions about this.
Exactly. It's the Financial Accounting Standards Board. They set GAAP. There are other professional associations and whatnot across the country that help interpret GAAP, and they produce various professional materials for auditors and accountants and organizations to have available to them. But ultimately, FASB, the Financial Accounting Standards Board, establishes GAAP, and they make it available in one handy location. There's an accounting standards codification that's available online for anyone to look at without a subscription. And the website is asc.fasb.org. And there's actually a section on there that applies specifically to nonprofit organizations, and that's section 958.
Okay, so we'll add that to the show notes as well so that listeners who want to click on a link can find it easily there. Let's move on to some nitty-gritty details. What does the first audit process look like for the charity? Now, we'll assume it's not a new charity, but it's new to audit requirements. Although sometimes I have private foundations that have a big slug of money that comes in on December 31st of a year, and it's more than $2 million. And so they hit the ground really running. So, what does it look like for that new nonprofit that has to get their first audit?
Sure. So at the start of the engagement, the auditor will provide what's called a PBC checklist. That stands for Prepared by Client. These items need to be assembled by the organization's accounting team and submitted to the auditors before the audit can actually begin. Then the next step in the process is what's called fieldwork, which can be done remotely or on site. During the fieldwork process, the auditors will typically meet with individuals from the accounting team, senior management, the audit committee of the board. They'll ask questions about internal controls, fraud risks, significant contingencies facing the organization, among other matters. Going through this process, it's important to remember that fieldwork is an iterative process where the auditors will ask questions and request additional documents. Then the organization will provide those documents and answer the questions. And then there's a few rounds of this. It goes back and forth for a while until the auditors feel that they have enough evidence to conclude the audit and prepare their report. This process can take anywhere from a couple of weeks if everything goes smoothly to several months, depending upon how complex the organization is and how ready it is for the audit process.
So what can new charities do at the outset to position themselves for an audit when they cross the threshold so that it's required based on their revenues?
There are a few things. First, the organization should make sure that its internal bookkeeper or accounting staff is proficient in nonprofit GAAP. If those skills don't exist in the organization, you may want to consider having your staff attend training or hire an outside accounting consultant to help you get ready for your audit. It's also important to have reliable monthly bookkeeping and accounting processes in place. I recommend doing this before you even start getting bids for an audit. Your audit will be a lot easier if your financials are always up to date. This includes doing things like making sure that the bank accounts are reconciled and making sure that receivables, payables, accruals, and deferrals are recorded in the accounting system each month. If these tasks are being performed by one employee in the organization, there should also be a second review by someone else. 2 sets of eyes are usually better than one, and this is especially true with accounting. Financial statements should also be provided to senior management and the board of directors or a committee of the board of directors on a monthly basis. This is important because it gives board members the tools that they need to exercise their fiduciary responsibilities. It also gives them the ability to identify anomalies in the financials that may necessitate follow-up with the accounting team. Lastly, it's a great idea to develop an accounting policies and procedures manual that discusses how the organization ensures its financial statements comply with GAAP, how assets are safeguarded, how donor restrictions are complied with, and how the organization's financial objectives are met. Going through the process of developing an accounting manual also gives management and the board of directors a great opportunity to brainstorm and address the adequacy of the organization's internal controls. Going through this process is not as daunting as it sounds. There are templates available that can help you get started. For example, Blue Avocado has a great nonprofit-specific accounting manual template, which is free to download online.
That's another great resource. We'll put that in the show notes as well. So sometimes I hear about charities that are surprised about the audit requirement that applied several years prior to the current one. What is your advice for addressing audits of financial information from several years ago when things are stale?
Occasionally, this can happen, and it can be more time-consuming to have to go back to information from several years ago because it may take a while to locate it. It's not entirely unheard of for an organization to get 2 or 3 years behind on audits. I was even contacted by an organization that did not know it was required to have an audit, and the state required them to go back 10 years. If you are behind on audits, first, what you'll want to do is find an auditor who has the capacity to help you get caught up. The other thing I recommend doing is working closely with your auditor to establish a reasonable timeline to get the audits completed. Now, if the state has already reached out to you about your delinquent audits, it's important to communicate with them about your proposed timeline and make sure that they are on board with it. Every situation is different, but it's been my experience that the folks at the Registry of Charitable Trusts are reasonable. They just want to know that you're serious about getting caught up on your audits.
Yeah, that's a really good point. I had a client a couple of years ago that had the California Registry did not notify them that they were delinquent because many years ago, a previous trustee had represented that they weren't required to get an audit. And it turned out that wasn't true. They were required to get an audit. The legal counsel successfully persuaded the AG's office to limit the audits to just the last, 3 years, because that particular client had been filing tax returns. And so there was other good evidence that the AG's office could look at that they had appropriate accounting. So anyway, I guess once you realize you're behind, the best thing to do is to start getting caught up. If the organization hasn't been audited in previous years, it's kind of tough as an outside auditor to just pick up going forward, right? I mean, usually auditors prefer to have a track record of prior year's audits before taking on a new client and starting the audit process.
Yes, absolutely. So typically, every situation is different. Some auditors, like our office, we prefer to do one audit at a time. We've tried doing 3 years at once before. It was very cumbersome and unwieldy. The first year is always the most difficult. So even if you have to go back to 2015 and do an audit of that year, that will probably be the most difficult audit to get through. And then you get into a rhythm. You can do 16, 17, 18, and each one gets a little bit more efficient because you get into a cycle and you're not spacing them out 1 year apart. They're bam, 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 one after another. So that's usually how it unfolds.
Yeah, and that's a good segue to my next question, and that is timing for getting an audit. That's often a challenge because there seems to be such a crunch time for the CPA firms. The audit usually has to be prepared before the IRS Form 990, and the 990 or 990-PF has a very rigid due date. There can be a real crunch when all the nonprofits need their audit at the same time. How do CPA firms manage that timing?
This is actually one of the trickiest things about my job. It's not all the technical pronouncements that are coming out every year. It's timing the audits. No matter how well we do with spacing the audits apart, invariably things will need to be shuffled around when organizations are not ready when their scheduled time slot arrives. So one of the best things an organization can do to achieve a smooth audit process is to be ready with a completed PBC checklist before your scheduled field date arrives. Also, it's been my experience that most organizations are not ready for their audit until at least the third or fourth month following the end of the year. So if you're an organization that keeps your books clean throughout the year, then getting ready for your audit should not be a heavy lift. You might want to talk to your auditor about doing your audit a month or 6 weeks out from year end, allowing you to beat the rush.
Yeah, that's a good point. And then your tax accountant waiting for the audit and getting it late October when the last due date is November 15 for the calendar year filing organizations. Anything else that you can think of that charities can do to make the auditors work as efficient as possible?
Going back to what we were talking about a moment ago with regard to having a monthly cycle of getting your accruals and deferrals, receivables and payables recorded, doing the balance sheet reconciliations. If you have a solid monthly process, that's going to help position you well for your audit. Also, having ready access to documentation. For organizations who've moved their files into cloud-based programs, that has worked out tremendously well for audit preparedness, because whenever we request documents, organizations are able to provide those documents. It doesn't matter if someone's working from home, they have access to them. Where we tend to see struggles is with the organizations that have all of their files in filing cabinets in paper form. That was especially difficult during the pandemic because people would have to sneak into the office on a Saturday to get the files that they need for the audit, to scan them. It works out much better when organizations are able to provide grant agreements, payroll tax documents, vendor contracts, all the audit documents that are part and parcel of our process when they're able to provide those electronically.
Yeah, that's a really good point. We've come a long way in the last 3.5 years now. Moving on to the deliverables, what does the client expect to receive from their auditor at the end of the audit process? What's the end point?
So audit deliverables typically include the auditor's report on the financial statements, which is sometimes known as the opinion letter, the audited financial statements themselves, and one or more letters to the board of directors or the audit committee. The audited financial statements will match the organization's internally prepared financial statements, plus or minus any corrections made as a result of the audit. The audited financial statements also include the footnotes to the financial statements that provide additional context for the amounts in the financial statements. And then the letter to the board of directors includes various items, but what it's typically well known for is that it's the place where the auditor reports any internal control deficiencies identified during the audit process. Now remember, unless you are having a yellow book audit or a single audit, Internal control deficiencies do not go into the actual audit report. Rather, the independent auditor's report only reports on the financial statements themselves.
That last item, the report, is that what's often referred to as the management letter that describes the deficiencies, or is that something else?
Yeah, so the management letter is a separate document from the audit report. And this distinction is very important because the management letter, that's a casual term. It usually has a name such as communication with those charged with governance or communication of control deficiencies. And that document is where any difficulties that the auditor encountered during the engagement would be disclosed, any material weaknesses or significant deficiencies in internal control, they would go there. That document is not subject to public disclosure requirements like the audit report is. So the audit report, if a funding source asks for a copy of your audit, you would provide the audit report that has the audited financial statements and the footnotes with it. It's usually one PDF document, but you would typically not provide the letter to the board or the management letter or the communication of control deficiencies. Those are meant for internal users. They're not meant for a general purpose audience. And you're not required to furnish that information to anyone on the outside of the organization. But the audit report itself with the financials and footnotes, that is subject to public disclosure requirements, at least in California. So if a member of the public requests a copy of your audit, that's what you would provide, not the letters to the board of directors.
That's a great distinction. The management letter or the internal controls letter, though, is very important to the trustees and the board. And a lot of organizations take that very seriously and they're very concerned about any deficiencies, although a lot of times they're kind of technical deficiencies and not necessarily an indictment of the organization's accounting.
That's a very good point. Oftentimes, especially for the smaller nonprofit organizations, the audit is really the only time that they're having outside CPAs come in and chime in on what's going on in the organization. And the types of deficiencies or recommendations that are brought forth in the management letter will vary tremendously. They can be anything from you've exceeded the FDIC insurance limits because you have $1 million in one bank, or it can be you're not accounting for depreciation correctly. And so for us, for auditors, those can be significant. And sometimes if we find that depreciation has been recorded incorrectly, we might report a material weakness to you. You as a board are then responsible to evaluate, okay, how significant is this to us? What kind of corrective action, if any, do we need to take? So it's not always what you might think of as egregious findings. It's not always going to be fraud or reckless accounting processes or things of that nature. It'll really be a wide spectrum of different things.
Yeah, that's a good point. I had a client once that was a religious organization, and they had properties that their churches were on that they'd had for like forever. And the deficiency that was noted was that they didn't get current appraisals. Well, nobody's going to go out and get current appraisals of churches. And so that's a kind of acceptable, at the time it was an acceptable deficiency. The auditor has to note it and say, hey, this isn't, in accordance with GAAP. But the board then makes its independent judgment about what to do with that information. So kind of wrapping up a little bit, the audit report, this is the document where the auditor expresses an opinion on the financial statements. Most organizations hope to get a clean opinion on their financials. What types of situations would lead to an opinion other than a clean opinion? And what does that really mean? What does clean opinion mean?
That's a great question. So if you're a nonprofit about to have your first audit, you may be thinking to yourself, we have really done our best to make sure our financials comply with GAAP. But what if we made a mistake? What if we left something out that's significant? We tried our best, but we're not perfect. And what if the auditor finds a material misstatement in the financial statements? Does that mean we can't get a clean opinion on our audit? I'd like to alleviate that fear if that question's going through your mind. It's not entirely uncommon for an auditor to find material misstatements in the financial statements during the course of the audit. When this happens, typically what will occur is that the auditor will bring the error to the organization's attention and give them the opportunity to correct it before the audited financial statements are issued. A qualified opinion and materially misstated financial statements do not do any good for the nonprofit or its funding sources, and audit standards acknowledge this. So let's change the situation a bit. Let's say your auditor finds a material misstatement and gives you the option to fix it, but you don't want to. That could lead to a qualified opinion. Let's say a donor makes a pledge to you just before year end, but you don't want to record that pledge or that promise as revenue until the following year when the money comes in. Perhaps you've already put it into your budget for the following year. Well, under GAAP, you are typically required to record a pledge as an asset as soon as a promise is communicated by the donor. If you felt strongly that excluding it from your revenue was the right thing to do, and that's what you wanted to do, and your auditor felt strongly that it needs to be included to conform to GAAP, then you might be looking at a qualified opinion. So a qualified opinion is when the audit report says that basically the organization's financial statements are reasonably stated in accordance with GAAP, with maybe one or two exceptions, and then those exceptions are explained. An unmodified opinion, which is a clean opinion, also known as an unqualified opinion, that is when the auditors state basically, we believe these financial statements are reliable. They can be relied upon by external stakeholders when they're making decisions that affect this organization. There's no qualifying language like there would be in the situation that I just described. Now, a GAAP departure, like the one I described with the unrecorded pledge, is one reason you might get a qualified opinion. Another reason would be a scope limitation, where the auditor is not able to get a high enough comfort level with something in the financials. For example, let's say you have recorded a large pledge receivable in the financial statements, but you cannot locate the correspondence from the donor that shows that they made a pledge. So you agree to let the auditor send a third-party confirmation request to the donor. But now let's say the donor is on an extended vacation and they're off the grid and they can't be reached for several months. In this type of situation, unless you and your auditor are able to come up with some alternative evidence that corroborates that pledge was made, you might be looking at a qualified opinion. So the auditor would indicate in the report that the final financial statements basically look okay, although they weren't able to verify this one pledge. All in all, qualified opinions are very rare, and they would involve large items affecting an organization's financial performance or financial position.
So, and that's a materiality kind of point, right? Immaterial departures don't come into play. I often get, as the outside counsel, I get requests from the auditor or from, actually, I think it's from the client to describe any material claims or material issues that I'm aware of as a lawyer. And there's a dollar threshold for what is material. So I guess my point here is just that not all issues are, the auditor might tell you about issues, not all of them are material, and we don't have to sweat the small stuff.
Exactly. So materiality is a very important concept in audits. And it's important to remember that when you have an audit, it's not the auditor's job to go through every transaction and make sure you've every dollar nailed down in the right spot. It's really to make sure that your audited financial statements tell a reliable story of what the organization went through for a given year and how it ended that year in terms of its financial position. So we don't sweat the small stuff. If we find immaterial issues, we make a tally of those immaterial issues and we present those to the clients, but we don't expect the client is going to fix those as a condition for receiving a clean opinion.
So that's a great way to wrap up. Any other final thoughts, Douglas, before we conclude our episode here? Any last words of wisdom for the new nonprofit facing their first audit?
I think that if you're going to be starting an audit, it's really to your advantage to start planning as early as possible. Audits take a lot of energy and take a lot of resources. It's not just the audit fee, but it's all the time and energy internally that you need to spend to make sure that your systems and your financial processes are audit ready. Definitely start thinking in advance. If you think that you're going to need an audit a year or even 2 or 3 years down the road, start going through some of these processes now with evaluating your own internal controls and conducting internal risk assessments, developing accounting policies and whatnot to ensure that your systems are sound and that you're well positioned for a successful audit.
That's a great wrap up. Thank you so much for joining me today, Douglas. This has been terrific. It's been great having you.
Thank you for having me, Cynthia.
So that's all for this episode. Be sure to check out the show notes for links to more resources. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun, and Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.